If you've ever wanted a reminder that markets don't move politely, this weekend delivered it with absolutely no subtlety. One day, everything is flying. The next day, it feels like gravity suddenly remembered its job. Today is February 1st, 2026, and we're looking back at what happened yesterday, Saturday, what many traders now jokingly call Smackdown Saturday. And yes, the name fits. What unfolded in the precious metals market wasn't just a pullback or a routine correction. It was a full-scale liquidation event that caught a lot of people leaning the wrong way. Gold, silver, platinum, and palladium all sold off aggressively, wiping out weeks, sometimes months, of gains in a matter of hours. The speed of the move was what made it so unsettling. When markets fall slowly, people argue. When they fall this fast, people stop arguing and start asking two very specific questions. What caused this, and what happens next? To answer either of those properly, we need to step back a bit, because this didn't happen in a vacuum. What we saw on Saturday was the violent end of a rally that had been building for more than a year. Gold and silver didn't just rise in 2025, they sprinted. Gold gained roughly 66% over the year. Silver did even more, rising well over 130%. Those aren't normal numbers. Those are the kind of numbers that pull in momentum traders, leveraged positions, and short-term capital that doesn't like to sit still. If you look at the gold chart going back to late summer, the story is clear. Prices started the move in the low 3,000s and climbed steadily at first. Nothing alarming. Then came December, and the pace changed. Gold pushed through $4,000, barely paused, and then accelerated again, breaking $5,000 as if it wasn't even there. And then came Saturday. Gold dropped just under 9% on the spot market, closing around $4,193. Futures did even worse, finishing roughly $150 below spot and down more than 11% on the day. That alone would have been enough to dominate headlines, but silver didn't just steal the spotlight, it kicked the door down. Spot silver fell more than 26% in a single session. Let that sink in for a moment. Over a quarter of its value gone in one day. Futures were hit even harder, down more than 31%, losing over $35. To put that in perspective, 6 months ago silver wasn't even trading at those levels. Platinum and palladium joined the move, down 17% and 16% respectively. There were no safe corners in the metals complex. Now here's where it gets important to stay grounded. These prices, especially the ones you re-seeing on screens right now, are not reliable reference points for physical markets. When moves are this violent, price discovery temporarily breaks. Coin shop prices, dealer quotes, international spreads, they're all over the map. Some markets freeze, others overshoot. So rather than obsess over exact numbers, the only thing that really matters at this stage is direction. And the direction, at least for now, has been down. So what triggered it? The immediate catalyst was political, not technical. President Trump announced his nomination for the next chair of the Federal Reserve, Kevin Walsh, a former Fed governor. The market reacted fast, and not thoughtfully. Walsh has long been labeled a sound money figure, largely because he resigned from the Fed back in 2011 in protest against quantitative easing. That single data point was enough for traders to assume a more hawkish Federal Reserve going forward. But markets often trade headlines, not footnotes. And when you actually look at Walsh's more recent statements, a different picture starts to emerge. His record suggests someone far more adaptive to political leadership than rigidly ideological. In plain terms, he tends to align with whoever holds power. That doesn't scream interest rates to the moon. President Trump himself has already suggested he expects rates to move lower, not higher. That nuance didn't matter on Saturday. Traders didn't have time to read, analyze, or wait. They saw sound money, assumed tighter policy, and hit the sell button, hard. The dollar responded immediately. The DXY, which had been drifting lower for much of the past year, jumped roughly 1% on the news. That may not sound dramatic, but in currency markets, it's a meaningful move. A stronger dollar makes dollar-denominated assets like gold and silver more expensive for foreign buyers. That shift added fuel to an already unstable situation. At that point, the selling fed on itself. This wasn't a gentle rebalancing. It was the unwinding of a crowded trade. ETFs tracking precious metals were slammed. The iShares Silver Trust lost over 30% in a single session, more than spot silver itself. Leveraged products fared even worse. The ProShares Ultra Silver Fund collapsed by more than 60%. If there's a lesson here, it's that leverage doesn't forgive hesitation. It amplifies everything, including regret. Now, here's the part most people miss. None of this automatically means the bull market is over. Parabolic moves always correct. They don't drift sideways. They don't politely give back 3% and move on. They unwind violently because they were built violently. When everyone is on the same side of the boat, the smallest shift in weight can cause chaos. History backs this up. Major sell-offs following long rallies often mark transitions, not endings. Sometimes they lead to deeper corrections. Sometimes they reset sentiment and launch the next leg higher. The key variable is not the size of the drop, but what happens afterward. If metals stabilize quickly, especially at levels well above their pre-rally prices, that signals underlying strength. If they continue to cascade lower without meaningful buying interest, that's a different conversation. Right now, it's simply too early to pretend certainty exists. There's also a broader ripple effect to consider. Moves like this don't stay contained. They impact equities, especially mining stocks. They influence crypto sentiment, particularly Bitcoin, which many investors still mentally group with hard assets, and they affect liquidity more broadly. When one crowded trade blows up, capital looks for the next exit or the next opportunity. What Saturday reminded everyone of is that markets don't care how confident we feel. They care about positioning, liquidity, and surprise is exactly what this was. So where does that leave us? For now, it leaves us watching, not predicting. It leaves us separating emotion from analysis. And it leaves us remembering that extreme volatility cuts both ways. The same market that erased months of gains in a day is fully capable of reclaiming a large portion of that move just as quickly. SmackDown Saturday wasn't the end of the story, it was a chapter break. And what comes next, whether it's stabilization, consolidation, or another wave of chaos, will tell. If you stepped back and watched what happened in the market without any charts or jargon, it probably looked chaotic, almost irrational. Prices didn't gently drift lower, they dropped hard and fast, the kind of move that makes people stare at their screens wondering what they missed while making coffee. But beneath that drama, there was a very mechanical process at work, one that has nothing to do with panic headlines and everything to do with how modern markets are structured. As prices started sliding, the first dominoes to fall were stop-loss orders. A stop-loss is essentially an instruction traders give to the market saying, I'm in this trade, but if the price hits this level, get me out immediately. Don't ask questions, just sell. It sounds sensible on paper, and for leverage traders, it often feels necessary. The catch is that when a stop-loss is triggered, you don't get the price you had in mind. You get whatever the next available price happens to be, and in a fast-moving market that can be meaningfully lower. It might be a few cents, it might be dollars. Sometimes it's whatever the market is willing to give you at that exact moment, and the market can be remarkably unsentimental. Personally, I've never been a fan of stop losses for long-term holdings, but the world isn't made up of people investing patiently with their own cash. A large portion of the market is trading with borrowed money, sometimes 10 times more than they actually have. When you're leveraged like that, you don't get the luxury of sitting through drawdowns. You need protection, because without it, you could lose more than your original capital. Stop losses are the seatbelts of leveraged trading. Uncomfortable, restrictive, but better than flying through the windshield. This is especially true on contracts for difference platforms, or CFDs. These platforms often allow traders to control positions many times larger than their actual account balance. 5 times, 10 times, sometimes far more. The platforms themselves are not interested in chasing people around the world for losses, so they enforce tight automatic stop losses based on account size. If the price moves against you beyond a certain point, your position is closed whether you like it or not. Futures traders operate under similar constraints. They trade on margin, typically posting only a fraction of the contract's value up front. If prices move against them, they're required to post additional margin immediately. If they can't, their positions are liquidated at whatever price the market is offering. Again, this is often executed via automatic mechanisms that behave very much like stop losses. Now, combine all of this with what we had just experienced. An enormous rally. Gold and silver had attracted a wave of short-term traders chasing momentum. The trade became crowded. And when trades become crowded, stop losses tend to cluster tightly together, almost like dry leaves piled in the same corner. It doesn't take much of a spark to set them off. Once the first stop loss was triggered, prices slipped a little further, which triggered the next set of stop losses, which pushed prices lower again. This process feeds on itself. It's not emotional in the beginning, it's mechanical, but very quickly it looks emotional from the outside. Adding fuel to the fire are the large professional players who know exactly how this game works. They can often see where stop losses are likely sitting. When they sense a cascade beginning, they may step in aggressively on the sell side, fully aware that pushing prices just a bit lower will unleash another wave of forced selling. Their plan isn't to panic. Their plan is to sell into weakness and buy back later at much lower prices once the dust settles. This is why these declines can feel so sudden and so violent. It runs less like a gentle slope and more like a staircase where someone keeps kicking out the steps. This domino effect is exactly what we saw. A parabolic rise followed by hair-trigger stop losses meant that even a modest pullback could set off a chain reaction. Once it started, it accelerated. Friday's move wasn't random. It was the inevitable result of a crowded trade meeting leverage. The shock didn't stay contained within metals. Other markets felt it too, although to a much smaller extent. Stocks dipped slightly. The Dow Jones and the S&P were down around 0.4%, while the tech-heavy NASDAQ fell a bit more. Nothing dramatic, nothing that would normally make headlines. The real pain showed up elsewhere. Mining shares were hit hard, and that's something many investors felt personally. If you've been holding miners for 9 months or a year, you're still well ahead. But if you bought in more recently, especially in the last month, the losses were noticeable. Some names dropped sharply. One silver miner was down around 17%, and others did even worse. Mining stocks tend to exaggerate moves in the underlying metals, both on the way up and on the way down. They don't do subtle. Bitcoin didn't provide much comfort either. Sometimes it's referred to as digital gold, but it didn't behave like a safe haven here. It's been trending lower since October and slipped further, dropping a few percent and drifting toward the high 70,000s. So both the old world store of value and the new world version were falling at the same time. The obvious question then is, what does a move like this actually tell us about what comes next? Is it a warning sign, or is it something else entirely? To answer that, I went deep into the data. This wasn't a casual glance at a chart. I spent the entire day studying historical crashes, going back as far as the data would allow. I started with the Dow Jones Industrial Average, analyzing every single one-day crash going back to 1885. That yes, over a century of market history and tens of thousands of data points. I was looking for crashes comparable in scale. Interestingly, truly massive single-day crashes are rare. There was only one instance where the Dow fell more than 15% in a single day. In that case, the market rebounded strongly. Within a week, it was up over 6%. And within a year, it had not only recovered, but gone on to make new all-time highs. One data point isn't enough to draw conclusions, so I broadened the scope. I looked at declines of 10% or more, but even those were scarce. So I widened the net further and examined all single-day drops of 5% or more. That gave me a much larger and more meaningful sample. 85 separate crashes since 1885. That's where a clear pattern emerged. After a one-day decline of 5% or more, the market was roughly twice as likely to rise strongly as it was to continue falling. Across different time frames, 1 week, 1 month, 3 months, 6 months, and 1 year, the odds consistently favored recovery. About 2/3 of the time, prices were higher rather than lower. At the 1-year mark, the average gain following these crashes was over 38%. That doesn't guarantee anything about tomorrow or next week. Markets don't operate on guarantees, but probability matters. And historically, selling after sharp, violent crashes has been a losing strategy more often than not. Panic creates oversold conditions, and oversold conditions tend to resolve higher. After finishing with stocks, I turned to gold and silver specifically. The data doesn't go back as far, but it still covers more than 2 decades and thousands of trading days. I identified every instance where gold or silver fell by 5% or more in a single day. The behavior was remarkably similar. Sharp drops were often followed by stabilization and recovery, not endless collapse. When you combine that historical behavior with the mechanical nature of what just happened, stop-loss cascades, leverage unwinding, forced selling, the picture becomes clearer. This wasn't a fundamental collapse, it was a pressure release. Markets have a habit of punishing the maximum number of people at the most inconvenient moment. Leveraged traders get flushed out, long-term holders get shaken, and then, once the selling pressure is exhausted, prices often begin to rebuild. Not because everything is suddenly perfect, but because the forced selling is gone. So while the move felt brutal, and while it certainly wasn't pleasant to watch, history suggests it is more likely to represent an opportunity than a signal to run for the exits. Not a certainty, but a probability. And in markets, probabilities are about as good as it gets. When markets take a sudden hit, our instincts usually kick in before our logic does. Screens turn red, social media turns dramatic, and everyone suddenly becomes an expert in hindsight. But instead of reacting emotionally, I wanted to do something far less exciting and far more useful. Go back to the data and see what actually tends to happen after these kinds of sharp moves in precious metals. So I looked at history, not just 1 or 2 episodes, but decades of price action. Specifically, I focused on what happens after a single-day crash of more than 5% in gold and silver, and then tracked where prices went in the days, months, and even a full year afterward. What came out of that exercise was genuinely fascinating, and more importantly, it highlighted just how different these two metals really are. Let's start with gold. Gold has a reputation for being boring, and frankly, it's earned it. A one-day drop of 5% or more in gold is an extremely rare event. Looking back over roughly 25 years of data, it's only happened around 10 times. That alone tells you something important. Gold is, relative to most assets, and especially relative to silver, remarkably stable. Now, rarity doesn't mean immunity. When gold does crash, people pay attention. So the question becomes, what tends to happen afterward? I examined gold's performance 7 days after a crash, 30 days later, and then 1 full year down the line. The numbers Don Tias always line up perfectly because in a couple of cases, the return was exactly 0, neither up nor down. But the overall picture is still clear enough to draw conclusions. Historically, after a 5% crash, gold was more likely to rise over the following year than fall. The sample size isn't enormous, so we should be cautious about claiming statistical certainty, but directionally the message is consistent. In the majority of cases, gold recovered. On average, 1 year later, gold was up nearly 14%, more than offsetting the initial drop. That recovery didn't happen overnight, though. This isn't silver, and it doesn't bounce like a rubber ball. Gold's rebounds tend to be steady, sometimes frustratingly so, but persistent. When gold did rise after a crash, the gains could be substantial, occasionally approaching 40%. But once you factor in the years when it fell instead, the average 1 year return settles closer to 9%. That may not sound thrilling, but in the world of capital preservation and long-term stability, it's exactly why gold exists in portfolios in the first place. Silver, on the other hand, plays a completely different game. A 5% single-day crash in silver isn't rare at all. It's practically a feature. Since the year 2000, silver has experienced 96 such crashes. 96! Anyone who held silver for any meaningful length of time has lived through stomach-churning volatility more times than they probably care to remember. Most of those episodes have faded into memory, but the price history hasn't forgotten them. When I analyzed what happened after those 96 crashes, the contrast with gold was striking. 1 year after a 5% or greater drop, silver was higher 56 times and lower 32 times, with a handful of flat outcomes. In other words, roughly 2/3 of the time, silver recovered. And when it recovered, it didn't do so politely. The average gain following a silver crash was around 38%. That's not a typo. Silver doesn't just crawl back. It tends to overcorrect in the opposite direction. Of course, that volatility cuts both ways. About 1/3 of the time, silver continued lower, which is why this metal is not for the faint-hearted. But historically, the odds have favored those willing to endure the ride. This leads to a broader principle that applies not just to precious metals, but to markets in general. The longer the holding period after a crash, the higher the probability of a positive outcome. Time is not just a healing factor emotionally, it's statistically relevant. Crashes often reflect oversold conditions, panic or forced selling. When that pressure fades, prices tend to mean revert, sometimes aggressively. Put differently, buying after a crash is not always the right move, but historically, it has been more likely to be a good move than a bad one, especially in volatile assets like silver. History doesn't guarantee the future, but it does provide context, and context is sorely lacking during moments of panic. Another question that often comes up during days like these is whether crashes in gold and silver are warning signs for the broader stock market. In other words, should we be viewing precious metals as canaries in the coal mine? I tested that idea as well by comparing daily moves in gold, silver, and the Dow Jones. The result? The correlation is weak at best. On days when gold fell by 5% or more, the stock market also fell about 60% of the time and rose 40% of the time. That's barely better than a coin toss. Silver showed even less predictive power, with stock markets falling 57% of the time and rising 43%. In short, a crash in precious metals does not reliably forecast a stock market collapse. That said, there are days when everything falls together. January 30th was one of those days. Gold, silver, and equities all declined in unison, signaling a classic risk-off environment where investors sold anything that wasn't nailed down. Those days tend to be driven more by macro fear and liquidity stress than by asset-specific fundamentals. So where does that leave us looking forward? Analysts are divided, which is another way of saying nobody really knows. The bullish case for precious metals hasn't disappeared. Geopolitical tensions remain elevated, central banks continue to diversify away from the US dollar. And before this correction, several major institutions were projecting significantly higher prices. Some banks were calling for gold at $6,000 in the next couple of years, while forecasts for silver stretched as high as $150. Corrections don't invalidate bull markets. In fact, they're part of them. Every sustained bull market climbs what's often called a wall of worry, and pullbacks are the price of admission. The real question isn't to whether volatility will continue. It almost certainly will, but whether this move represents a temporary reset or a structural turning point. A lot will depend on how markets interpret upcoming policy signals, particularly around interest rates and central bank leadership. Analysts will be digging into recent speeches, voting records, and broader policy alignment. Markets rarely wait for certainty. They move on perception, and that perception can change quickly. And what does seem likely is more volatility in the near term. Markets don't usually find equilibrium overnight. They probe higher, then lower, until a new consensus forms. If history is any guide, though, the odds favor recovery over time, especially for silver, which has repeatedly demonstrated its tendency to rebound sharply after periods of extreme selling. Before wrapping up, I want to mention one practical point that often gets overlooked. During periods of extreme volatility, physical gold and silver markets behave very differently from paper prices. Dealers widen spreads dramatically because they don't know where prices will settle. That means buyers often pay well above spot and sellers receive well below it. Acting in haste during these periods can be costly. If you feel compelled to act, doing so in very small increments can help manage regret, regardless of direction. Personally, I'm sitting on my hands. I had no plan to sell before the drop, and a lower price alone isn't a reason to abandon a long-term thesis. Sometimes, the most difficult action is no action at all. Markets will settle, spreads will narrow, clarity will return. Until then, patience isn't just a virtue, it's a strategy. And on that note, thanks for spending the time with me. I genuinely appreciate the thoughtful comments and engagement. They don't go unnoticed, and some of them have been genuinely moving. Until next time, take care, stay rational, and don't let a red screen make decisions for you.